Welcome, everyone, to Name Confidential Live.
Hey, welcome everybody to Name Confidential. I'm this week's host, Ryan Redfern. Today we have Chris Miller at South Pointe Advisors in New York City. Chris, good to see you. Thanks for being here today.
Absolutely. Thanks for having me, Ryan.
Awesome, awesome. Of course, we have the disclosure slide up here. Let me stop that and let's flip to the name exposure index here. Let me share this real quick, and there we go. And I believe you are a contributor.
I am. Yep. Every
Nice,
week I
nice.
join and try to contribute. Yep.
Nice. Well, this week we're at 79.29. It's just below 80. It's an interesting key number from a lot of people who
Mhm.
study it. What did you report this week?
Reported back 100%. So even though all the choppiness that's going on, the underlying rotation in the market, when we look at the indices, we really haven't been triggered on our risk on, risk off type models at this point.
Mhm. Nice, nice. I'm glad to hear that because I also reported 100 this week for the same reasons.
Yeah.
I'm just not seeing it. I mean, I don't love this market, but it's bad, but it's not that bad, right? Nothing to be.
Yeah. The
Yeah.
rotation we've seen rotation out into some more of the traditional defensive sectors, right? So you've seen
Mhm.
utilities go up, staples, things like that rotate out. At the same time, we look at the index level. We haven't really seen any real significant move. It's been a kind of consolidated sideways pattern really since October.
Mhm.
So I think a lot of people are just watching. I know we are, and our models are mostly quantitative,
Yeah.
systematic. We're really just watching to see kind of which way it's going to break. Because at some point, it's going to go one way or the other. But at this
Right.
point, we really haven't seen any data or evidence that's shown us which way that's going to break at this point.
Yep. Yep. No, I'm seeing the same. So I'm on the same page with you. I'm curious who's really dialing down their risk. I mean, and not like they've been wrong. I mean, they've backing off hasn't been a bad idea over the past couple of weeks, but big picture, I'm just not seeing it either. So I think that's interesting. I appreciate the take.
Sure.
All right.
Yep.
Well, let's dive into you. What got you started in the investment side, and we'll get into philosophy and how you think about the markets as well. But what was your journey getting to being an advisor and even an active advisor?
Yeah, well, I always say I've had the career trajectory of a ping pong ball. I've definitely
Nice.
had many different careers. I started my career, I went to undergrad here in New York City, a school called Fordham. And I was lucky enough back then, I got an internship with a pretty large fee-only advisor at Oppenheimer. And so I started with him early on. That was probably about 20 years ago at this point. And back when I started with Oppenheimer, it was really managed mutual funds. So it was kind of a completely different game. Really wasn't an opportunity to go independent. I ended up going back to business school, went into the energy sector. So I've worked oil and gas for the last 10 years. And I really wanted to go come back into the wealth management side when I started to see my parents kind of struggle to get good retirement advice.
Yeah.
So about 3, 4 years ago, I came back in. I picked up some clients pretty quickly, and some of the portfolios that they brought over, there was kind of stuff buried in there
Mhm.
that was completely foreign to me that I'd never seen at Oppenheimer, right? Oppenheimer were just kind of 60/40, some version
Yeah.
of the stock bond split. It was managed mutual fund models. We really had very little input into the investment side. And part of that was for compliance. They just didn't want the advisor getting into those accounts too much. So when these accounts came over a few years ago, I started seeing a lot of these tactical managers, and I was just curious at first what was going on there. And it just so happened that was like 2022, right when we had the initial sell-off, and some of those managers did really, really well.
Mhm.
And that really piqued my curiosity. I was like, well, what are they doing there? And that kind of kicked off a journey ultimately to the CMT and to kind of where I'm at today with
Right.
focus on active management.
That's right. I forgot you are also a CMT as am I. That's awesome. I love how many
Yes.
CMTs are in the name community. So it's
Yep.
it's really
It's great.
growing. That's interesting that you said your parents. That's kind of always where it starts. Certainly, it always starts personal, right? Where you see somebody getting advice that's really not that great or sometimes just bad, and it really kind of makes some of us, I mean, certainly myself as well, step up and go like, okay, I can do better than what I'm seeing out there. The bar is sadly very low for
Yes.
good advice. I don't know why that is, but there are a lot of underwhelming people in this industry. But there are a lot of fantastic ones as well, like you said, like you alluded to. There's some really good managers who know how to protect the downside. So, and any more insights into that as to what brought you here?
Um, Yeah, I was really surprised. It had been a pretty big gap from when I was at Oppenheimer to
Mhm.
today, right? Over 15 years. And I think one of the biggest things that was surprising to me was how little the industry had adapted specifically for the retirement community.
Yeah,
They were really still being presented solutions that really I felt didn't fit
yeah.
for the average retiree. And that showed up, explicitly with my dad, who went to kind of the largest wealth manager in the country.
Mhm.
And the advice that he got, I felt even today, especially with everything that's going on with private credit and that, they just
Yeah,
had these like crazy allocations. The risk reward just made no sense
right.
for someone in his age bracket and his goals. So it was just really, really shocking to see that the industry, for whatever reason, really hasn't caught up, especially on the retirement side, which is my focus, with any type of focus on kind of active risk management.
Love it, love it. Yeah, and I think a lot of people, certainly the public, doesn't really appreciate risk management until the market starts to suck, and then it's
Yes.
like, okay, we're all worth our money at this point. Usually, for the most part, people are good at it
Mhm.
and understand what's going on. Well, awesome. Well, how does this? Let's segue from that into your investment philosophy. What did you see, and what got you to thinking how you think about things now?
So a big part of it, when I started to kind of take a look to see what was working so well with those tactical
Mhm.
funds in 2022, I started to see that there's actually a system and a method behind it. It wasn't really just pure luck, right? And that was, it may seem obvious to people who have been in active management for a long time, but for someone who started on more of the traditional broker side, even as a fee only, it really was kind of the antithesis of what we were told as an advisor, right? We were really trained to come in there and to present these models, and they were diversified, and we did a lot of good. But we were always prepared, like to deliver the hang in there, ride it out type, mentality and mantra. So to see these active managers come in was really opening, and it's really the CMT program
Mhm.
when I decided to go through that and spend a couple of years that really started to show me, okay, there is a systematic process here to manage risk, and it's been around for a very long time, and it's very effective.
Yeah. Yeah. No, it absolutely is. Yeah. And the CMT really opens you up to the whole world of that. And you kind of what I love it's so broad is you can really kind of even in there find your niche that's like, okay, this is what makes sense to me. And you can kind of take a path in that active world. Active doesn't mean like one thing. I think too often name is like, oh, but it's a bunch of day traders. I'm like, maybe it was 30 years ago, but not really. It's mostly trend traders who
Sure.
are just aware of what's going on in the environment and adapting watching this exposure index, not adapting that fast. It's more a slow trend following. So where did you land as from a strategy standpoint? Um,
Yeah,
how do you
so
think
we
about
started.
models? And how do you think, yeah.
Yeah. So we started off using a lot of third-party money managers,
Mhm.
and they were good. And I think the key challenge that I found that ultimately led to moving the models in-house was the ones that were successful, who weren't advisors, right? They seem to have almost a disincentive to update or make any changes to the model once they got good at fundraising. For
Yeah.
example, going into 2022, we saw, for any type of risk manager, if it was a risk on, risk off, for a lot of these tactical money managers, the risk off asset was a long duration type bond, which got absolutely hammered, right? And we saw this with one of our managers that we were using. We went in there and we were able to override that and kind of opt out of that into kind of a cash equivalent early on. So we had that ability, which was nice. But they held on to it and they ultimately made the change, but it was after the carnage was done. So seeing this kind of alignment of incentives, ultimately decided, okay, I want to go through the CMT program. We want to bring the models in-house to make sure that they're really best aligned with our end use clients. So for today, we run just really a really basic, systematic risk on, risk off to
Mhm.
try to put some level of downside protection in there. And then some type of basic risk management too on the bond or equity sleeve if we're using bond funds for that as well too.
Yeah. Yeah. No, bond, if you get to know the bond market, it's very easy to do a good job there, but you have to spend some time with it. And
Yes.
you're absolutely right. It was wild to watch. Really, until like 4 or 5 years ago, you could just buy treasuries when the market sucked, and it was like, hey, easy
Yeah.
money. That
Yep.
stopped very abruptly. And
Yes.
I know
Yes.
some managers who did the same thing. They're like, well, this always works, so I've got to keep doing it. It's like, reassess. You should, have your stops on these assets as well.
Well, I think, TLT, the 10-year, I mean, that thing took a 47% hit. I mean, you're talking a drawdown like we saw in 2000 with the dot-com bust and stocks or the great financial. That's really incredible. And I think there was I don't know what happened. I know they wanted the long duration to pick up an extra point or two, but it really introduced a tremendous amount of risk into that
Mhm.
and was kind of fell apart a lot of these tactical funds at that point.
No, for sure, for sure. Yeah, and there's a lot of stuff out there in there. And it was interesting that too to watch the aggregate, which is the standard diversifier, like make nothing for 3 years in that period. I mean, it's finally starting to break out a little bit. Okay, maybe there's something there, but as a diversifier, that's like hurting your performance, right? I always get
Yeah.
well, active management doesn't help your performance. Well, sometimes proper allocation doesn't really do a whole lot either, right? You got to pay attention to everything you have.
Yeah, yeah, exactly. Yeah, I think people don't realize that because we see a lot of times people come to us and they tried a lot of times by the time I talk to them, they've tried to take steps to mitigate the risk. And part of that includes they'll come in with 20, 30 different funds, right? Some
Mhm.
of them they'll still be highly correlated, and other
Right,
times, they are, but other times if they can diversify, you have to understand you are diluting the returns and the upside too, right, from that standpoint. And just putting more money into bonds or trying to put into stuff and holding on to maybe emerging markets when it wasn't working too.
right.
That also has a detrimental effect that can compound over time.
Yeah, no, absolutely, absolutely. Yeah, we should get into the that side as well. But so, are there any bond spaces that you like to watch, or you lean into, or are you pretty much open to everything that's out there?
So we're pretty much open to anything. We keep it
Mhm.
pretty streamlined, pretty simple. Our clients are mostly retirees and pre-retirees, so the focus for them is really on maintaining cash flow.
Right.
But in terms of watching what's going on, I mean, not necessarily individual vehicles, but obviously credit spreads are usually a big
Mhm.
component. Those can be a leading indicator that there's an underlying problem, right?
Yeah.
Similar to we saw 2007, 2008 type area.
Yep. Yep. Absolutely. That makes me think of I think it was Greg Morris's book. I don't know if you've read that one. One of the first things in there shows like if somebody taking distributions and they go through this big 50% drawdown, how that just destroys their income, their retirement income if they're living off that money. So having risk mitigation makes all the difference. And the downside risk is so much more important than the upside gains, really, when you get into it long term for somebody who's trying to live off the income. So yeah, no, I totally understand you've got to manage risk first to make income last. It's not about outperforming when things are good.
Yeah, absolutely. It's not just that. I always say there's like the financial, there's the math side, right? Which is
Mhm.
important because it's sequence of returns, which is kind of what you're talking
Yeah,
about there, right?
yeah,
That can be really, mathematically deadly. There's also the psychological side too, that once that paycheck stops, right, people do start
mhm,
to look at their money differently.
yeah,
And I talk about it like it's like playing poker for like dollar antes versus like $1,000 antes, right? And the stakes kind of go up there in retirement, I found. So even if mathematically we can show you that you could weather the storm through 30, 40, 50% drawdown, psychologically, I found most people are not really going to be able to spend through there, even if we could show them something that they can make it through, right? They're going to make adjustments. It's going to have an impact on the lifestyle. And then, if they get unlucky and there's kind of a spending shock, which could be like a medical bill,
mhm, yeah,
some type of remodel, something like that, that's where we can really get into problems, specifically for the average retiree.
right, right. No, absolutely it makes a huge difference, and I love that. I love seeing that there are more and more people out there embracing these thoughts instead of
Yeah.
going, no, you do 60/40 and you buy and hold and it's just going to work out. It's yay. Makes me cringe.
Yeah.
So I guess we've kind of hinted on this, but how you use active management, and if you don't mind going into like anything you really like to look at, how do you come at it, and how do you build models, and how do you do all these things?
Yeah, so we ended up going down and building kind of a composite scoring system, and it has
Okay.
a couple of internal and external variables that go into it that generates a daily composite score. So it's a daily signal. On the internal side, we were talking things like price, momentum, right? We're looking at moving averages, things like that.
Yeah.
We're getting the data into there. On the external side, it could be things not necessarily moving the price of that security, which for us, we're looking at, S&P 500 traditionally.
Yeah.
But then on the external side, could be things like sentiment, VIX, right? Credit spreads, things like that.
Yep.
And from there, it kind of gives us a good kind of data, right? So instead of us going in and trying to figure out, okay, we have this news going on here, we're kind of really able to quantify it from there and also back test it and see how that's done in different kind of market regimes. And so that's kind of the core engine of our risk management for the equity piece on that daily signal. And then the fixed income side is a little bit slower moving. It's typically kind of a monthly rebalance that we're doing on that side.
Okay. Okay. A little bit slower then. So do
Yeah.
you use, how do you, once you have the market context with your big picture and your, you know, composite signal, how do you decide what you go into at that point?
Yeah, so we did really rigorous back testing to see kind of how it did under different regimes, and then we set our thresholds there that we
Okay.
want to hit, right? So it's a 0 to 100 score, and we have two kind of thresholds there for our buy signal and our sell signal that we use.
Mhm.
So we'll evaluate every day. Every day that score is generated. If we hit one of those thresholds on the buy side, right? If we've been out of the market, we'll go back in. If we're out, we'll exit out of the market, typically into cash or cash equivalent, since we're not really taking the duration risk at this point.
Gotcha, gotcha. So do you also like taking it when you're in a risk on signal? Are you just like S&P, or do you go like, hey, value is beating growth or growth is beating value, and you lean into a side, anything like that?
Yeah, so we really haven't been kind of drilling down that
Okay.
level to value versus growth or sector rotation. It's something that we're looking at too. I think there's maybe some value there in terms
Mhm.
of having a piece that's always exposed on a sector rotation side. But at this point, we really want to get kind of the simplest kind of risk
Mhm.
measurement, most effective way to do it into there in a way that the clients could understand too. Because part of the feedback that we got a lot was that clients would have these statements that they just really didn't understand, right? So if we can get a portfolio down from 20, 30 positions to maybe 2 to 3 really cost efficient, tax efficient ETFs, right? That
Mhm.
helps them to get their head around it. And then that serves as the base for them. If they want to add complexity onto there with alternatives or other trading strategies,
Sure.
then we can start to kind of build around that. And that's what I found personally to be a little bit more effective.
Yeah, simplicity really does go a long way in what we do. Yeah, and ETFs certainly on the equity side are more efficient. Do you only equity ETFs on the bond side, or do you do both?
We will do both. So
Okay.
depending on the client's needs, we will do kind of individual bond positions too.
Oh wow.
It's
Okay.
gonna, yeah, it'll depend really on the client and needs. But I'd say for the most part, we're using the ETFs. We found that to be a pretty cost efficient, good way to manage the risk and still get some income exposure on there.
Nice, nice. I know there are a couple of very big bond traders in the name community, and they lean into the fund side because it's easier to manage risk. I don't know if it's worth spending some time on.
Yeah.
I'll certainly, if you're, we'll talk about it
Yep.
later, but you'll be at the name conference in Florida, and I'll certainly introduce you, and you can get to know
Great.
how they look at these
Yep.
things, because it's getting to know these people or getting to know other people in the industry who are really good at this. It's like, oh wow, I never thought about, you know, the mutual funds versus ETFs in the bond space, or certain niches of it make such a big difference from volatility standpoint.
Oh, absolutely. Yeah, I'd imagine. Yeah, they sound to be much more in the weeds in that than I am on the bond
Oh
side,
yeah,
but
yeah,
I can
yeah.
imagine. Yeah.
No, no,
Yeah.
you're keeping it simple, but when
Yeah.
you start going, okay, I can make this a little bit better, you start going, oh, it might be this over this, or these little tweaks will,
There's always that temptation because
yeah.
especially the CMT side, right? If you're plugged in and if you like the markets, I watch Bloomberg pretty much 6, 7 days a week. I mean, there's
Oh, wow.
always a temptation to tweak.
Sure.
But at the same time, I found that I want to make it something simple that's very
Yeah.
effective improvement, but also that the clients can get their head around because a lot of times they are coming from that traditional 60/40 split.
Yeah.
And
Right.
just getting the idea of risk management into the plan, this may be the first time they're even having that conversation.
Mhm. Yeah. Yeah. But in practice, they love it once you get an environment like this. So I love
Yeah,
what you're doing.
absolutely.
Cool.
Yep.
Well, we talked about any kind of chart sharing. You might have any charts you want to share that you're looking at, what you're thinking about right now? We got some time.
Sure. Yeah, I can take you through some charts. Let me see, just share my screen real quick.
Yep. Certainly without giving away the secret sauce, and I understand that, but there's always high level stuff you can kind of look at and go, oh,
Yeah, high
here's
level,
how I
just kind
think.
of. Yeah, absolutely. Absolutely. So, this is kind of the daily charts here. And I
Mhm.
really, when I'm looking at it, I'm really thinking, daily, weekly, monthly. So I don't know if you can see my tabs above
Yeah.
here.
Yep.
But we're looking at it, usually starting at the daily side, then the weekly and the monthly side. So when we're talking just kind of the broader index and we're talking, okay, why are we still 100% invested? given all the headline risk out there, it's just because the rotation really hasn't been, from what we can see, kind of strong enough to drag down the whole index. That could change in the future. We can see here, but if we look in like October here, right, we see this is kind of really where we really kind of topped out here, and we've gone
Yeah.
sideways since the end of October. So November, December, right, January, February, coming up 4, 5 months, we've gone
Hmm.
sideways here. And if we start to see when we kind of show clients this and we start to show them the graphs, we try to keep it simple, but when we try to show them the price movements, they usually start to get it, right? And we start to take a look at technology and we've seen it's kind of come down.
Yeah.
Here we can kind of see the rotation that's coming out of the market, and we can see that too here from the Nasdaq side. So when we're looking at kind of the overall markets, where we are looking at the consolidation side, we've seen the kind of 21-day and the
Hmm.
50, but we're still well above the 200-day, which is going to be the barometer in our
Yep.
view for most funds. And there's just so many algo or quant funds, right? Where the 200-day is like
Yep.
the line in the sand. So if that gets
Yeah.
triggered, that's usually that's not a great sign, at least short term, unless people are going to step back into here. But we still have a rising 200-day average here, and we just have some consolidation going on. And on the daily side, we've seen a slowing in momentum, right, as that rotations come out, but it's nothing like really uh, super damaging yet, right? Because the rotation out hasn't been super strong. And if we go here
Hmm.
on the weekly basis of the S&P 500, here again too, then we can see we're still again same thing where we came down, we came off. This is Liberation Day.
Yep.
We came down, we bounced back up, right? We had a really sharp run. We ended up 17% for the end of last year for 2025, driven really by the money went going back into those tech stocks, right? And
Hmm.
it's kind of just stalled out from here. And it's the same thing if we look at the monthly side here. This is interesting here where we can really see it on the monthly side, right? Where if you're a CMT, so you know the names of these candlestick patterns, right? There's actually meaning behind these hanging mans and things like
Yep.
that. We can start to see, okay, now it's really evident here that we're really in an indecisive manner. And we've had this here where February was kind of the first real kind of down month we've seen right since November here. So we're starting to
Hmm.
see, okay, something's going on. We just don't know to the extent of how that's going to be. And so the way it works for, you probably know this, but I found a lot of retail investors don't realize that the difference between a market cap weighted and an
Hmm.
equal
Yes.
weighted, right? So when we own the S&P 500, if it's a Vanguard or Fidelity, right, you
Hmm.
have a major concentration in maybe 7 to 10 stocks, right? Those
Yep.
those magnificent seven or those lagging seven that they call it now, right? And
Right.
so we had a kind of a pickup in the RSP, and then a kind of sell off here too. Some of this is due to the volatility with the Middle East conflict. But we've really seen this is really kind of what's been driving it recently, right? This is kind of the software sector. And it's really this idea that, okay, is software as a service dead, right? Because we have a
Yeah.
lot of big companies, tech companies that are making their money selling software.
Hmm.
So I think this is a really interesting chart to watch here, where we've had this really kind of nasty drawdown
Yeah.
of over 34 or
Jeez.
35+%
Uh-huh.
from the software companies, when really I think it was Cloud or Anthropic that came out and
Hmm.
was like, okay, guess what? Our AI can now kind of do a lot of this work on its own. And you can go in and see this in stocks like Adobe,
Hmm.
Salesforce, that type of thing, right? We can see this play out at the corporate level, right? We can see if we look at Adobe, this is
Oh, wow.
a a really brutal kind of it's been in the drawdown. It's accelerated
Hmm.
55%. Same thing for Salesforce. These are all kind of software as a service, right? They make their money. They have a software they're billing on a monthly basis or
Hmm.
whatever. Again, down 45%. So we're really watching things like this to see kind of what plays out. And then again, you see on the hardware side though, right, the actual chips,
Hmm.
SMH, which is a ticker, tracking the semiconductors, it has held up kind of okay. So it's really been more so on the software side than the hardware side.
Hmm.
So we're really watching to see kind of where that money is going. And we look at things like, you were talking value versus growth, right? And
Right.
we that's kind of one of the intermarket analysis that we look at here,
Yep.
where we can see where there's been kind of a shift back to the value side.
Mhm.
But again, these are all kind of short-term trends, and we really can't say for sure, which way it's going to shake out. So generally, we look at it at the index level, then we go down to kind of the industry, the sector level, right? The technology
Mhm.
side, the consumer discretionary, right? The growth side, the communication side. The energy side has taken off, obviously, with oil
Yeah.
kind of really ratcheting up with the close of the Strait of Hormuz. The financial side. So we can see kind of where the money's been rotating into, right?
Yep.
The industrials, the materials, the consumer staples, real estate, et cetera. So those are kind of the general things that we take a look at. And then from there, there's always a bunch of interesting things I can talk about that, I don't want to take up too much time, but we look at like the dollar. There was a lot of talk about the dollar just being done, the de-dollarization, but then we see anytime there's any type of panic in the markets, right? We do have a downward sloping 200-day, but we see we're getting back to about $100. And if we look at this kind of zoomed out, we are down off its peak, but if we go back here, it's not a crazy move.
No.
So those are the sort of things we're looking at. And then, of course, metals. And of course, I have a natural gas company, legacy company. I'm always tracking natural gas,
Sure.
always trying to anticipate where that's going to go.
That's awesome. That's awesome. Great insights. And yeah, the big picture, the long-term moving averages are still holding up. There's not a lot
Yep.
of reasons to, certainly on the S&P specifically, but you showed that the trend is still there, and we're just having this little choppy sideways. We're still within the October range. I mean, which I know that's a long time ago, but it's not like we're not breaking out. We're not taking off in either direction. So that's worth certainly worth noting. And I think I like you. I'm a little more, I don't say bullish, but I think there's more opportunity. I don't think we're in a crisis. We're not in a we need to be selling everything and hiding just yet. So
Yeah, there's nothing. The credit spread. I mean, the VIX is elevated now with the war in the Middle East. We're about 28. But
sure.
there's still the underlying economy is still fairly. We haven't seen any major cracks when it comes to unemployment, credit spreads, typical data that we see there. So I think it'd be premature to say, not that it couldn't happen.
Yeah.
But yeah, we're just watching it to see what happens. And of course, that's part of the nice thing about having some type of daily system, right? As that
Mm.
data flows through, we'll
Yeah.
start to get those signals, and then we can react based off the data instead of trying to guess what actually is going to happen.
Absolutely. Makes all the difference. Well, awesome. Awesome. As we kind of wrap up here, I've meant to ask, do you have a favorite investment quote that drives
Sure.
your work?
Yeah. So the one we use the most often with clients is the Warren Buffett's famous two rules, right? Rule number one, don't lose money. Rule
Yep.
number two, don't forget rule number one. I found that if you study any successful investor over time, they have some focus on downside protection and understanding when they go into position, kind of the risk reward ratio. So I think that that's really my favorite.
It's that is key for trading, for swing trading, for every time frame. So no, I love that. Love that. Great quote. And of course, we've got our NAAIM Uncommon Knowledge Conference coming up April 26th to 29th in Tampa, Florida. Are you going to be there?
Absolutely. Yep. Looking
Cool.
forward
So
to
I'll get
it.
to see you in person, and we'll talk more about this stuff. I'm sure over drinks or something at some point. So awesome. Well, cool. Chris, thanks for being here today. Great to spend time, get to know you a little bit better. Share your wisdom with the world, and look forward to catching up with you soon in person.
Absolutely. Appreciate it, Ryan.
All right, we'll see everybody next.